Hello and welcome back to the Gold Newsletter. My name is Kai Hoffmann. I'm the EdJR Mining Guy on Twitter and the CEO of the SOAR Financial Group. And together with our friend Brien Lundin, I'm the host of this Gold Newsletter channel where we host company interviews. And I'm really excited to welcome back John McConnell of Victoria Gold. John, it's great to have you back. It's good to see you in the studio.
Yeah, no, good to be here. This is home after all.
Absolutely. Well, we share an office. It's not a big secret. So really appreciate you hosting us in here. And it's always good to get the occasional update from you because, as I said, I say that every time. It's always great to talk to a producer because the perspectives are very, very different. Let's just jump right in and ask you, how are you feeling at 2340 gold? How are you doing?
Well, I'm a bit surprised like everybody, but feeling very good about the gold price and the potential to go even higher. I think there's still lots of room for gold to go higher.
Absolutely. The World Gold Council put out their monthly report for March just this morning, actually. And most of their the price move is unexplained, according to their charts. It's not just momentum or risk aversion or anything. It's unexplained, which is really, really interesting.
Well, I have an explanation. And it's a quote I saw from Rick Rule. And he said, I own gold because I'm scared I'm going to wake up one day and it's going to be $5,000 an ounce. And I think that's what is driving it right now. It's got nothing to do with the Fed and interest rates or safe haven. It's got to do with now that it's started moving, people don't want to miss it. So I think that the market's going to drive gold to over $3,000 in the next couple months.
A month ago, I would have told you you're crazy, quite honestly. Like, I wouldn't see it, but now I'm starting to believe in it because part of the gold report that came out from the World Gold Council was, of course, ETF inflows and outflows. And Europe, we saw massive outflows, $1.4 billion in March, but the US started to see inflows. So, and only like 240 million or so, nothing crazy. But that's starting to come. I think we're starting to see some FOMO kick in as well, and maybe some momentum chasing. So it's going to be interesting. And it's been violent though, that move. So we'll see if that corrects itself over time, or if it continues up in a hockey stick formation here, right? Yeah. No, fantastic. John, we're chatting. Today's April 9th. So the first quarter is behind us. The winter is almost behind us as well. I see the cherry trees blossoming outside. How was the winter for you at Victoria?
Well, winter's not over in the Yukon. I saw a photo this morning of probably 3 inches of fresh snow, and I think it dropped to -5 last night at site. So not quite over yet, but we've been snow-free, but you get these spring snow storms, and so it's still troubling in winter. This was our second full winter of stacking. Production was similar to 2023. But one thing we have learned is that people are just not as productive when it's -40 as they are when it's +20. So, we pushed the guys. We just didn't see the productivity we had hoped for at the mine. So very similar numbers to a year ago, but we had hoped to improve both the fourth quarter and the first quarter of 2024. But, we'll always be a bit of a seasonal operation. And, as the farmers say, you got to make hay while the sun shines. We got to make gold while the temperature's warmer. So, we'll make up for it in Q2 and Q3.
Maybe you need to start serving more hot soups or something as well. So no, that is interesting, like with the productivity, because also we talked about employment and HR issues in the past, of course, of operating somewhat remotely. Has that changed at all? Like I know you've been going, because turnover was an issue back in the day.
Yeah, turnover is still an issue. It's improved. 2022, our turnover was over 35%. Very difficult to run a mine with that kind of turnover. 2023, we're down to 20%, and we'd like to push that this year down to, 10 to 15%. You're always going to have some turnover, and some turnover is healthy because then you can promote people. People aren't stuck driving a truck constantly. You get the opportunity to train them on a shovel or a loader. So you do want some turnover.
What are some of the levers you can actually pull to make that happen, to drop it by almost 50% if we were to assume 10% turnover?
Well, I think it's just the availability of people. During COVID, governments paid people to stay at home, and people got used to that. And it's only been the past year people have started to come back into the workforce. So we're seeing, and we're talking that segment of the population between 20 and 35. And they're coming back to work now. I've got a good example. My neighbor here in Vancouver, their son moved back into the house during COVID, and probably 4 months ago, his father gave him the ultimatum: "It's time to get out and get a job, son." So he's working at Eagle right now.
There you go.
So, we're seeing that across the board. But, people have a lot of choice. There's a lot of new mines coming into production in Canada this year. Just saw, Equinox is commissioning at Greenstone. They started running, so that's a new mine. And so there's going to be a lot of pressure. And what we have to do is make sure we've got good employment conditions. We don't want to necessarily lead the pack in terms of salaries and benefits, but we want to make sure we've got good food at the camp, we've got good internet, the gymnasium is up to date, and people can go and do their exercising in the evening and that sort of thing. So we just have to work at it.
You're guiding a little higher all-in sustaining costs for 2024 in comparison to 2023. Is that wage increase or wage inflation? Is that part of it? Would you consider that?
Yeah, that's part. Fuel seems to have leveled out. That's our second largest cost. But if you've gone to the gas pumps like I did this weekend, fuel in Vancouver's up over $2 a liter again.
I was going to say, I saw $2.10 yesterday.
Yeah, so fuel's a tough one, and you feel it double when you're working in the north because all the fuel comes from the south. So the transportation costs more, and the actual fuel itself costs more. So yeah, we're doing things we can to get costs down, but I think the new reality is, all-in sustaining costs across the mining industry are, maybe 4 years ago they were $11.50. Today they're $14.50, and that's what we're seeing. I think our costs for 2023 were $14.70, and we'll see something similar in 2024.
We're seeing that across the board. I don't think it's a big surprise. So it's not just Eagle's cost creeping up. It's overall as well.
Well, yeah. I mean, I like to look at something like a Barrick or a Newmont where they have 20 mines, and you can get a sense of what's happening, and they're all at $14.50 to $1,500 now.
Yeah, absolutely. I got ahead of myself asking you about your guidance, or mentioning the guidance, because we really haven't chatted. It's actually for a while. I think last time we chatted in person was probably in New Orleans. I'm trying to think, which was at the end of October, early November. And you put out your annual financials and production results in January 15th, I believe, and then financials right after. Let's talk about guidance and what the plans are for this year. What are you guiding?
So our guidance is 165 to 185, about a 10% increase over last year if you look at the midpoint. And we'll continue to ramp that up over the next 3 or 4 years and get up over 200,000 ounces per year. But it's baby steps, and I've learned my lesson about over-promising and under-delivering. So, we've been quite conservative in our estimates, and, we've learned that shit happens in the mining business. We had to evacuate last summer because of forest fires, and we lost 2 weeks of stacking and gold production. So, those things can happen again.
Absolutely. Let's break down, though, how you're planning to achieve that increase in production. Productivity is probably one thing. You mentioned that earlier. But what are some of the other steps you could take to increase that?
Yeah, it's mostly related to people, getting the turnover down, as I mentioned earlier, getting people trained better so they're more productive and they make less mistakes. We're still tweaking with particularly the crushing circuit, different style of liners or different quality of liners in chutes, and all of that is to improve availability and utilization of the plant. And that, it's not big things anymore. It's tweaking little things that are going to give us that 10% increase in throughput over the course of the year.
Interesting. I was going to ask you, how does exploration play into that? But that seems to be a different discussion or a different factor, not weighing directly onto Eagle production.
Yeah. So we can talk about exploration. Our budget for this year is $10 million. We still haven't finalized exactly where that's going to be spent. We kind of have two groups. We have the team that's leading the development of Brewery Creek, and then we have the team that's leading the development of Raven. So they're making proposals for money for this year and what they want to spend. But, it'll be split, probably a couple million on Raven, a couple million on Brewery Creek, and then some of our other projects like Clear Creek, Gold Dome, and Lynx will all get some attention this year.
Yeah, fantastic. Awesome. That's, you mentioned budgets. Let's talk about budgets, because I saw a big item of sustaining capital in your recent release, or January 15th release it was. Where do you have to invest? Where's that money going? I think it was $35 million in sustaining CapEx for this year.
Yeah, there's a small amount for replacing equipment and rebuilds of our major equipment. I think we plan to rebuild 4 trucks and 1 loader this year, and so that shows up in the all-in sustaining costs. And then the big item is something we do annually, expanding the leach pad. So not only is it expansion of the leach pad, but we put a conveyor up the side of the leach pad so it's more efficient to move material. So that's probably $20 million this year.
Scrolling through the presentation, I mentioned it to you beforehand, I couldn't immediately find mine life. How much longer mine life is, because we just talked about exploration. Guide us a bit through that, because you're talking about exploration upside at the lower end at depth at the Eagle mine as well. Let's focus on that for a second.
Sure. So, our mine life, if you go back to our technical report, which is a year old now, and we plan to update it in another year, we replaced everything we mined in the first 2.5 years. And that's a long strike to the west and at depth. We'll start a drill program around Eagle later this summer or early fall. And the plan is that we'll replace reserves that we've mined the last 2 years. And, it's pretty evident that it's, we have to do the drilling, but it's pretty straightforward. And the reason we don't do it is because it is an added cost, but it also interferes with mining in the open pit. So we have to time everything properly and do it sequentially. But, my gut is that this mine will run for the next 20 or 30 years. And I base that on the fact that, the current open pit goes to 350 meters. And we've now drilled a dozen holes down to over 850 meters. And we see very similar mineralization and very similar grade at depth. So it's a matter of economics that, can we push the high wall back? And there's a capital cost to that. And, we're doing the feasibility work on that right now. But, with higher gold prices, the debt reduced, it really changes the economics of future ore onto the leach pad.
You'd lose a nice viewpoint if you push the wall back, though.
Oh, we'd still have it. It would just be further to the east.
Okay. I like that viewpoint. So I've been on there 10 years ago for the first time. It's fantastic. Let's talk finance and markets maybe a little bit, or cash flow, I think is really key, because one of the highlights you have on your, I think, second or third slide of the presentation, it says highly levered to the gold price. And now at 23.40, I have to ask you, what's the cash flow situation? How is that looking?
Well, I just say, people can do the math themselves. I've already said our all-in sustaining costs last year were, $1,470, and we're guiding now, somewhere between $1,450 and $1,650 for 2024. And if you use $1,550, which is probably conservative, gold this morning, I think you told me, was $2,340. So say there's a margin of $800 per ounce. We're guiding that the midpoint of our production this year will be 175,000 ounces times, say, 750. You can do the math and figure out what the free cash flow is. Now, there'll always be capital costs that aren't included in all-in sustaining, and, you don't include interest in all-in sustaining. So, but we should have free cash flow of 50 to 100 million this year, depending on that.
So now I have to ask you, what are you going to do with that money? Like, are you going to focus solely on debt repayment? I saw you have a non-course issuer bid going as well. So buying shares back, dividend. Let's talk about those scenarios.
Well, let's start with dividend. And, you're from Germany, and I hear from our German shareholders all the time, when are you going to start paying a dividend? And they're very focused on that. But that's the only place I hear about dividends. No. I don't think...
And I'm German. I'm not even looking for it. I'm a growth...
I'm a large shareholder, and I would rather see Victoria, if I'm looking at it from, or any other gold mining company, be focused on reducing debt and buying back shares. I think that's the best of the three options we have. If I do like dividends, but I get a far better dividend if I buy bank stocks or utilities. So that's where I focus. I buy gold equities because I love the leverage to the price of gold.
Absolutely. And if you reinvest that capital, you can actually grow that share price. I think share price appreciation is, in my opinion, way more valuable than 2% in annual dividends. Like, that's way below the inflation rate anyway. So that's a completely different discussion. So let's talk working capital as well. How much cash do you have right now, and how much access to cash do you have?
Yeah, so, I think if you look at our year-end financials, we probably had in the order of 15 million in cash. And we keep it around 15 million. But we do have a revolver. And we use the revolver the same as you use your bank account. If we have excess cash, we put it in, pay down the revolver. If we need cash, for a one-off payment, or, we draw on that revolver. The revolver is currently at just over 100 million and has capacity of 120. And, we're focused on paying down the term facility. It started in 2018 at 100 million US, and today it's down to 16 million. So that's been our focus, and we'll make the final payment on the term facility, October 1st of this year, and then we'll start focusing on the revolver facility. We also have an equipment lease. It's at very good terms with Caterpillar. So we pay that down quarterly, but we also buy new equipment when we need it. So I think we'll probably always keep that at, roughly 30 million, and the facility has capacity for 50 million. So
it's probably cheaper than bank debt anyway.
It is, yeah.
So,
and it's guaranteed by the equipment. So.
No, absolutely. No, that makes a lot of sense, because audience might have noticed I'm steering the conversation towards, of course, like what could be next, right? Like, there's two avenues. Either you get acquired, because in my opinion you're still undervalued for 175,000 ounce producer a year at not even 400 million market cap, with an enterprise value of close to 600, I guess. So there's room, of course, for any single asset producer, or anybody actually out there. It could be an interesting asset. But if we flip that around, you could go out and acquire. So that's why I was asking, how much cash do you have available? And another question I want to ask you, like, at what point do you start considering your shares as acquisition currency?
Yeah, we I would say considering its acquisition currency is getting the cart ahead of the horse. I mean, we look at a lot of properties, and to be quite honest, we haven't found anything we really like. We have a good pipeline of development assets in Raven and Brewery Creek, and we have a good pipeline of exploration assets in terms of Gold Dome, Lynx, and Clear Creek. So, what we really like is to add another producing asset, and they're few and far between. And there's a lot of competition. The mid-tiers all want to grow, and everybody's very cashed up. We've looked at things like Marathon and their Valentine property. We looked at Argonaut's Magino property, but they just weren't good fits for us. And we're going to be very careful. We think we found a unicorn in Eagle. We bought a unicorn in Brewery Creek, and we're going to continue to look for unicorns. Things that other people have missed.
I was going to throw coffee into that discussion, but I think everybody and their dogs looked at coffee. So,
well, Newmont ran a process a couple years ago, and I'm told, we didn't make it to the second round. We made an offer, and I'm told that when the two companies that did make it to the second round heard that Victoria didn't make it, they dropped out as well, because they figured there must be something there that they missed. But, there is a new process Newmont's running to sell a large number of their Canadian assets. And, we'll sign a CA and get into data rooms and look at both the producing assets and the development asset coffee one more time.
Well, that's the job of the corporate development department on a daily basis anyway. Tire kicking to a degree as well. No, fantastic. One other question I had, defense strategies. You are, I wouldn't say not vulnerable, but you're an interesting or appealing acquisition target as well from that perspective. I mentioned valuation earlier. What's a possible defense strategy? Would you even want to defend? Let's discuss that. How hard are you willing to fight?
We think we have lots of upside for shareholders in Victoria with, both year-over-year improvements at Eagle, but also, we would like to see Brewery Creek come back online in the next 3 to 5 years, and it'll be a small producer. It'll produce 50 to 60,000 ounces of gold per year, but it's a nice little operation.
I was going to say $3,000. That's not too bad.
It's in our own backyard, so that's the kind of thing we'll be doing. And, if somebody comes along and, makes our shareholders a reasonable offer, we'll certainly take it to our shareholders. But we think we've got lots of room to improve things for our shareholders right now.
So you're going to fight for a while.
Yeah. Well, I wouldn't even say it's fighting. We just, we don't entertain offers. So if somebody wants to come in, they're going to have to come in with a very good
series
offer.
number.
Yeah.
Series number. No, fantastic. John, I think we covered a lot of ground. Anything else we should be looking forward to in 2024?
Well, you're going to come for a site visit?
I haven't been invited yet.
You're always welcome.
Any news items, catalysts, anything else?
No, I think, for us now, we've become a bit of a boring story. People are closely looking at our quarterly numbers, and, we'll have some exploration results, but probably not till the fall of the year. It's just head down, get Eagle running properly and improving.
Fantastic. Awesome. John, I don't think I have any other questions. It was quite extensive and comprehensive as well. Really appreciate your time. Always great seeing you, and I love doing these in person.
Yeah, that's great. And we'll see you in Germany soon.
Absolutely. What was it? 4 weeks now. Fantastic. Looking forward to that. Everybody else, thank you so much for tuning in. The Gold Newsletter interview here with John McConnell of Victoria Gold. Hope you enjoyed the conversation. Let us know. How do we do? Like, how do you like the questions we asked? Of course, we have a good relationship with John. We want to get something out of it for you. Like, that's why we're doing these interviews. If you have any questions, please put them down below. Leave a like, leave a comment. And if you haven't done so, subscribe to the channel. Truly appreciate your time. Thanks so much for tuning in. We'll be back with lots more. Thank you.